Suvankar Sen, Managing Director and CEO of Senco Gold, joins us now. So there's lots to talk about. You've raised money via QIP, gold and festival demand. Gold demand is strong. Indians importing more gold, stock at an all-time high. What should we start with?
Whichever, I think we'll all cover all together. So as far as first the raising of the money, I think that is very important and something to talk about. We have seen that in the last 1.5 years, gold prices have gone up by about 20-25%. So our expansion plans continues to remain. So this money that we raise, while initially we will utilize it to reduce the debt for the short term, but over a period of time, there are two, three initiations that we will do with it. First one is that we have seen that after the duty cut in the month of July, August, we had seen a surge of sales. The sales really picked up. There was a lot of demand, a lot of wedding jewelry buying happening. So we realized that if in the top performing stores of ours, if we can put in more inventory, the possibility of higher sales would be there. And that is where, almost one third of the money that we raise will be put in replenishing of the stocks in the top performing stores. And then every year we intend to open 18 to 20 odd stores, 10 odd company owned, company operated, and 8 to 10 franchisees. So in the company owned, company operated stores, obviously, metal gold loan is the way to go, where hedging also happens, and your cost of funds are lower. But this equity that we raise will obviously help in leveraging and increasing the debt, so that the debt equity ratio continues to remain in a balanced state. And we will be utilizing it for the new store openings that we'll do maybe in Q4 and the Q1, Q2 of the coming financial year. And the remaining 100 odd crores that shall remain, all the new projects, branding, marketing, building up the back end strong factories, all these things, new various projects are there. So under general corporate purpose, we will be utilizing it. So that's how the overall plan is to utilize the money for the QI.
Okay, so can you just elaborate a little bit more? What is the debt equity that you're targeting? How many jewelry showrooms are you likely to add annually? And what mix of this QIP raise is going to be used for jewelry versus non-jewelry?
So this, the debt equity ratio for us, we believe in certain, financial discipline, a number, it should continue at 1.1. That is how we would like to look at it. So our debt is, most of it is working capital and metal gold loans. So, against the 450 crores of equity that we raise, we can raise around 450, 500 crore of debt, and that would give a 1,000 crore kind of a liquidity buffer cash that will enable us to continue to grow in the future. That is how we would like to look at the overall situation. As far as the new store openings question that you asked, 8 to 10 company owned, company operated stores, the simple mathematics is that for every store that we open, we will need about inventory of 20 to 25 crore. So your 10 to 12 stores will need about 250 to 300 crore of inventory. And the capex to open the stores is anything between 2 to 3 crores. So that's about 20-30 crores of capex. So that's about it. So that will give the leverage for the new store openings, and for the next 2 to 3 years it will just become a very automatic thing, because every year kind of an estimated pat of 200, 220, 250 crore based on the year that it is, that will always, the reserves and the profits that you generate will continue to help you to grow automatically year after year. So that's how the whole plan would be, as we move ahead.
Uh, Everybody is expanding. You are expanding. Kalyan is expanding. Titan is expanding. There would be a threshold at which you would say, okay, India can only absorb X number of stores, X number of branded stores. How does it work? What is the right way of looking at it? Are these number of stores? Are these penetration levels? What is the best way to looking at it?
So the best way to look at it is where you are expanding. So like our focus of expansion is East India and North India. East India would be the core market of ours, where we have been there for more than 80 years. And what we are seeing is the growth happening in the tier 2, 3, 4 towns. It's not really the city expansion, unless the city is expanding and growing and you're opening up stores in the newer residential areas where you see the whole rural urban migration happening. That is one part of expansion. The other part of expansion is that you penetrate into the smaller tier 2, 3, 4 towns where there were maybe jewelers there, but now the consumers also has an inclination to buy from brands, to get the latest designs, and then they would look to go to a branded jewelry store with the latest designs and the good services. So that's the whole change I think all the branded jewelers are looking at. And let me tell you that in Q2, when the duty cut happened, and we spoke about it, that we saw that the sales or the growth in the smaller towns through our franchisees were much higher compared to the urban cities. So there is a change happening. But yes, maybe after 4 5 years, once all the expansion happens, then you need to figure out that where the next level of expansion is. But coming 3 to 4 years, this unorganized to organized, I think the unorganized sector itself is also getting organized. But I would rather say that from the small and the medium jewelry companies and stores to the larger branded stores, it's more of the look at it that is the way the consumers are moving and the business is also moving.
All right. Request you, Suvankar, to just stay on with us. We want to take a moment to just mark the fresh listing of the day, and that is Sai Life Sciences. That's going to make its D Street debut in a few seconds from now. Remember, it's a contract researching, development, and manufacturing organization. All right, we'll have to see what the D Street debut has been at about 650. So that's close to an 18% premium to the issue price. That was suggested. It's 3,034 crore rupee IPO, and the subscription was about 10 times during the 3 days of bidding. That was between the 11th and 13th of December. All right, let's get a move on and right back to business. So, Suvankar, just wanted to get a sense from you then as to what the outlook is in terms of lab-grown diamonds as well, and how that part of the business is performing, and what you're looking at in terms of the future. Is there going to be a coexistence of both natural and lab-grown, or will one eventually eat into the other?
So the lab-grown diamond business, since the base is very small, and I would say that right now in the overall business, it is a very small percentage, maybe even less than say 0.5%, because the value itself is smaller, and it's just a beginning. There are only 4 stores that we have opened with lab-grown diamonds. The consumers are getting to. I would say that while we at the investor community or the business community are much more aware of what it is, and what are the potentials and what is the benefit for the consumer, and there is like the large number of consumers who are still trying to understand that what exactly the lab grown diamond is. So while we are very much on top of things, the consumer has to become more aware. But the thing is that as a value for the consumer, be it the middle class or even the upper middle class, there is a value, because when you are looking at owning a big size solitaire or a big size diamond, then obviously when you buy a lab grown, it is much more affordable compared to a natural diamond. So if you look at from a fashion sense, if you look at from your day-to-day wear sense, then for a consumer who has the aspiration, they will buy. When you look at from an investment sense and an emotional sense, that it's your wedding or it's your special occasion, then that feeling of owning something precious, then the natural diamond shall continue to remain in the main in the mind of the consumers. That is one. Second, when it comes to the small size diamond, like below 11 cents or 2 cents, 3 cents, that is where I think that lab grown diamond and the natural diamond still has an edge over lab grown. So we are seeing that it is only in the bigger size that there is a little more attraction and traction towards lab grown. And if you ask me, what do you see, Suvankar, over the coming 5 years? I would say that in terms of value, we need to be very clear, because the lab grown value is something which is almost 1/4, 1/5 of the value of the natural. So if there is a stud ratio for any jewelry company, say of 20-25%, then the lab grown diamond share of the overall business will not be more than 4 to 5%. That is one way of looking at it. And the second way of looking at it is that gold prices will continue to be on the upward trend. That is a fact. Today it is at 70,000. Tomorrow it will be at 80, 90, and 18 carat, 14 carat. Even in the future, government is talking of creating 9 carat hallmarking. So when such a thing happens, then people will buy gold, but they buy something studded into the gold. It could be gemstone, lab grown, diamonds, any colored stones. So that is where I think lab grown diamond will play a role in creating variety designs and more modernity to the jewelry segment. So I think that's the way to look at it. And it will be an important part, but it will not substitute the natural. Natural will remain as a precious asset commodity, and lab grown will remain as a fashion commodity. That's the way to look at it.
So that's the way to look at it, natural versus lab grown. Thanks, Mr. Sen, for making time and speaking with us today. Really appreciate you joining us on the show. But a quick look at...
If you like this video, then like, share and subscribe to ET Now.